G'day and welcome to this week's video. My name's Robert Gowdy from Consortium Private Wealth, and thanks for having a look at our video. This week it's just a follow on from a client appointment I had the previous night at work, and we broke down the scenario in terms of his planning into three steps, and it's probably what financial advisors and smart investors do on a regular basis without really thinking about the process. So I thought I'd just jot it down to sort of break down the process of the way that I was thinking for this particular client on how he should save and invest. So step one, and obviously I think I've done a video before, if you don't save something then all the other steps are a little bit useless. So savings plan, budgeting, cash flow, all really boring things, but if we want to be able to save for our retirement, we need to put some extra money aside. So if we work out what we can save on a weekly basis or in line with your pay rates, I've always been a big fan of chunking things down into your pay cycle. So if you get paid fortnightly, you estimate all your expenses, and you only do this once. There's a video that I did only a few weeks back that budgeting doesn't need to be hard, so go back and check that out. So work out what you can save. Then step two is we really want to see, you want to do it as tax effectively as possible, and is superannuation going to be a completely easy win? So if you can save per year $10,000 after tax, your before tax figure is a much higher number. So for the scenario that we had for the client, he was saving into a investment property loan, which is now paid off, $2,000 per month. In before tax figures, that is actually $32,000 per year. And so of that $32,000, that allows this chap to maximize his $25,000 concessional contribution. So on that 15 grand that goes in addition to his employer contributions, he's saving nearly 20% per year. That's the easy win, and then obviously that money gets to be invested. So with superannuation, obviously think about the tax rate of 15% on the way in compared to your marginal tax rate, which can be as high as 47%. So save money, step one. Obviously set a budget, save some money, do it once. It doesn't need to rule your life. Step two is how can we save tax effectively? Superannuation is the low-hanging fruit and the easy win, which I've spoken about in before, and that's just the difference between 15% superannuation contributions tax rate of concessional contributions and your personal tax rate. Then once you get all these things organised, then you have the opportunity, if my computer will work. Step three is where to invest. And this is really important to get this part right to maximise returns for the rest of your life. Now on our website, there is a free course. It's a series of 6 or 7 videos from Peter Thornhill. So making sure investing in the right asset allocation. We'll put the link down to the descriptions. It is well worth having a look at, and going through that to maximise your returns, making sure you're investing in the right area that's going to give you the best return over your lifetime. Now for those that know me or get advised by me, have seen these videos in the past, that is essentially investing into businesses. Now for people that run their own businesses, reinvesting into that business. For those like many of my clients, were investing via the share market to buy businesses, and over the long term buying businesses and a diversified range of businesses in different countries doing different things in different sectors have outperformed property and of course cash, particularly those very low interest rates. So these are the 3 simple steps that I went through sort of unknowingly, that I said, right, what can you save, or what have you been saving for this client? How do we do it really tax effectively, grab that low-hanging fruit, and then we need to work out where you're going to get the best return for the next 40 and 50 years for this client who is mid-40s. So I hope that's a help, and thank you for listening. Please subscribe to the channel if you haven't already done so, and for those that have, thanks very much, and we'll see you next week. Cheers.